Greetings, dear learners. Welcome to CEC Gurukul lectures. In the series of accounting process, in the previous lecture, we talked about accounting process, meaning of account, traditional classification of accounts, wherein we discuss about real account, nominal account, and personal account. What are the rules which are applicable under this traditional classification for debit and credit? Meaning and format of journal. So all these things we had discussed in the previous lecture. In today's lecture, we are going to talk about some more journal entries, that is compound journal entry, opening entries, goods account, special journal entries. Compound journal entries. When more than two accounts are involved in a transaction and the transaction is recorded by a means of single journal entry instead of passing several entries. Such single entry is termed as a compound journal entry. Let's understand this compound journal entry with an example. There is a transaction on 1st February and it is given here that we have received cash from Rakesh worth rupees 2000 and from Rohan rupees 500. So in this particular transaction, more than two accounts are involved. More than two accounts means this transaction involves two persons, name of two persons, Rakesh and Rohan. From Rakesh we have received rupees 2000 and from Rohan we have received rupees 500 and we are receiving cash. So instead of passing two different entries for cash, we will pass a one single entry. Instead of passing two different entries, that is cash account debit to Rakesh and cash account debit to Rohan. So instead of passing these two different entries, we will pass a one single entry, and the entry, compound entry for this particular transaction would be cash account debit to Rakesh account and to Rohan account. From Rakesh we have received 2000 and from Rohan we have received rupees 500. So what we have done in this particular journal entry, we have not passed two different journal entries for the cash. We have not passed the entry cash account debit to Rakesh account and cash account debit to Rohan account. We have passed a single entry and this entry is known as a compound entry, or you can also say combined entry. Let's take one more example. On 10th February, there are three transactions. Goods purchased for cash worth rupees 5000, furniture purchased for cash rupees 2000, paid salary in cash rupees 1000. So on 10th February there are three transactions wherein we have purchased goods, we have purchased furniture, we have paid salary, and all these transactions are in cash. So instead of passing three different entries for cash, that is purchase account debit to cash, furniture account debit to cash, salary account debit to cash, instead of passing these three entries, we will pass one combined entry, one compound entry, and the entry would be purchase account debit 5000, furniture account debit 2000, salary account debit 1000 to cash account 8000. Remember this thing always, whatever amount you are showing in the debit column, that means you are showing total amount in the debit column is 8000. The amount should be same, this should be equivalent to the credit side. So you have shown 8000, 5000 plus 2000 plus 1000 on the debit side. The same amount should be shown on the credit side, because in accounting debit equals to credit. So these were the combined entries, compound entries. Now come to the opening entry. Opening entry is a journal entry by means of which previous year accounting period balances of various assets, liabilities and capital are brought forward in the books of accounting period. Whatever is the closing balance of the previous year will become the opening balance of the current year. All the firms which are in the running business will have a opening entry. Let's understand this with an example. All opening entries will be on the beginning of the financial year. So this entry is on 1st April 2018. It is given here, the balances of previous year balances are shown here, and you have to record this as a opening entry. Assets and liabilities are given. Assets is given cash rupees 6,000, bank 17,000, stock 3,000, bills receivable 7,000, debtors 3,000, buildings 70,000, investment 30, furniture 4,000. These are the opening balances of assets given to you. Liabilities are shown here. Bills payable 5,000, creditors 9,000, Ram's loan 13,000. These are the balances of liability. Now, how to record these opening balances? In the books of account, you have to record this opening entry in the beginning of the year, because this is a opening entry. So this entry would be recorded in the beginning of the year. So our year is beginning on 1st April. Let's take an example. Our year is beginning on 1st April 2018. So this entry would be recorded in the beginning of the year, and all assets would be debited. All assets would be debited, as we have done in this particular general entry, that cash account debit 6,000, bank debit, stock debit, bills receivable debit, debtors debit, building account debit, investment account debit, furniture account debit. We have debited all assets, because according to the modern approach of this for the rules posting debit and credit, according to the modern approach, you have to debit all the assets and you have to credit all the liabilities. According to that approach, all assets would be debited and all liabilities would be credited. So what we have done in this particular general entry, we have debited all the assets given to us and we have credited all the liabilities given to us. So assets account debit, 2 liabilities. The total of all the assets, which are shown here is 1,40,000, and the total of all the liabilities which are given here is 27,000. Now there is a difference on the credit side, and this balancing figure of rupees 1,13,000, this balancing figure would be treated as capital account. If there is a balancing figure, assets minus liabilities, then that balancing figure would be treated as a capital account. This is opening entry. Now come to the goods account. In accounting, the meaning of goods is restricted to only those articles which are purchased by businessman with an intention to sell it, not to retain it. So, in accounting, goods account is never open. In place of goods account, the following accounts are open in the books of accounts, and these accounts are purchase account. If we are purchasing goods, then in that case we'll open purchase account. If we are selling goods, there is a entry goods sold for cash, so we'll not open the goods account, we'll open the sales account. Similarly, if we have returned goods to the supplier, in that case we'll not write goods return, we'll write purchase return account, or we can also say return outward account. If our customer has returned goods to us, in that case we'll open sales return account or return outward account. We'll not open goods return account in that case. So in accounting, goods, whenever there is a word goods, so that is always denoted with the name either purchase account or sales account or purchase return account or sales return account. We'll never open goods account in the accounting. Now, next one is trade discount. Let me first explain you what is trade discount. This trade discount is usually allowed on the list price of the goods. This trade discount is basically given by the supplier to promote trade. That's why it is known as a trade discount. And this trade discount is never recorded in the books of accounts. It is given on the list price. Let's understand this with an example. Goods purchase of the list price of rupees 10,000 at 10% trade discount from Mr. A. So the list price here is rupees 10,000 and the trade discount is given 10%. So how to record this amount? The entry would be purchase account debit to A, that is your supplier. In this particular case, we will not record this particular journal entry with rupees 10,000. We will record this particular entry with rupees 9,000. That is after deducting trade discount. This trade discount is never recorded in the books of account. So the entry would be purchase account debit to Mr. A. Mr. A is our supplier from whom we have purchased goods. And why we are recording 9,000? Why we are not recording 10,000? Because 10% trade discount is given by the supplier to promote trade, and this trade discount is not recorded in the books of accounts. We will record this entry with rupees 9,000. That means in future we have to pay to our creditor, who is Mr. A here. We have to pay him rupees 9,000 only. Next type of discount is cash discount. Cash discount is a concession allowed by a seller to a buyer to encourage him to make early cash payment. Since cash discount is given, then this discount is a nominal accounts. It is a loss. So it comes in the nominal account. Let's take an example. X owes rupees 10,000 to Y. He pays rupees 9,500 in full settlement against the amount due. The total amount due was rupees 10,000 and he pays how much? 9,500, and the word is written here, that is full settlement. What does it mean? Full settlement means nothing is left. The final amount which you have to pay is 9,500. So out of 10,000 you are paying 9,500. So 500 is the amount of cash discount which is given by the supplier. So in this particular case you have to record this 500 as a cash discount, and since cash discount is an expense, it comes under the nominal account. And the rule of the nominal account which we had discussed in the previous lecture is, nominal account rule says debit all expenses and losses, credit all income and gains. And according to that rule, the entry would be, if you are passing this entry in the books of X, then the entry would be Y account debit rupees 10,000 to cash, since we have paid 9,500 and we have received, X has received a discount of rupees 500. So for him, because he has received discount, when you are receiving discount, then this discount receive is a income for you, and all type of income and gains comes under nominal account. And the rule of the nominal account says debit all expenses and losses, credit all income and gains. Because of this rule is applicable here. That's why we are crediting discount receive, since X receive rupees 500 as a cash discount. In the books of Y, if you have to pass this entry in the books of Y, then the entry would be cash account. Since he is receiving cash, cash is coming, then entry would be cash account debit rupees 9,500. The total amount due was 10,000 on X, but he has received how much? 9,500 after a deduction of cash discount worth rupees 500. Since he has given rupees 500 as a discount to Mr. X, so this rupees 500 for him is a loss. Then all type of expenses and losses comes under nominal account, and the rule of nominal account says debit all expenses and losses, credit all income and gains. So discount, if you are receiving discount, then that is an income for you. In that case you have to credit that discount received, as I have shown in this example. And if you are giving discount, then that discount is a loss for you. In that case you have to debit that. Next is depreciation. Depreciation is the gradual permanent decrease in the value of an asset. Depreciation is charged on fixed assets, and this is because of the wear and tear and many other causes. Depreciation is an expense, but this depreciation is not a cash expense. So we never pass entry depreciation account debit to cash, because it's not a cash expense, it's a non-cash expense. So the entry for the depreciation would be depreciation account debit to asset account. Depreciation is an expense. All type of expenses comes under nominal account, and the rule of the nominal account, debit all expenses and losses. Because of this particular rule, what we are doing, we are debiting depreciation, and this depreciation is being charged on asset. So the value of asset is decreasing, and all type of assets comes under the real account, and the rule of the real account says debit what comes in, credit what goes out. Nothing is going out here, but the value of the asset is decreasing. So because of that reason we are crediting asset account. The entry would be depreciation account debit. On depreciation nominal account is applicable, and on asset real account is applicable. Two rules are applicable here. The entry is depreciation account debit to asset account. The next one is bad debts. What are bad debts? If a debtor of a business fails to pay the amount due from him, then it is treated as a bad debts. Bad debts are losses, so all type of losses, expenses comes under nominal account, and the entry for the bad debts would be, since it is a expense and all type of expenses, losses comes under nominal account, and the rule of the nominal account says debit all expenses and losses and credit all income and gains. Since it is an expense, that's why we are debiting this bad debts account. To debtors account. Why we are crediting debtors? Let's understand this with an example. There was a debtor of rupees 1000. He became insolvent and we could not recover this 1000 rupees from him. So in that case we have to remove this debtor from the list of debtors, because he is not in a condition to pay this amount of rupees 1000 even in future. He became insolvent, so he is no more our debtor. If he is no more our debtor, in that case we have to remove this particular debtor from the list of debtors. And when we have recorded this debtor, at that time what we have done, we have debited this debtor. When we have recorded debtor, then we have debited this debtor. Now we have to remove this debtor from the list of debtors. So in accounting, if you want to remove something, you want to close some account, in that case what you have to do, you have to reverse the entry. So at that time when you recorded this debtor with rupees 1000, you have debited him. Now you want to remove this debtor from the list of debtors. What you have to do, you have to reverse the entry. So you have to credit this. The entry would be now bad debts account debit, since it comes under a nominal account, and according to the nominal account you have to debit all expenses and losses. And since you are removing this debtor from the list of the debtors, that's why you have credited it. The next one is bad debts recovered. When any amount become irrecoverable from any customer or debtor, his account is closed in the books. If in future any amount is recovered from him, then his personal account will not be credited, because that does not exist in the books. It is an income. Let's take the previous example. In the previous example we said one debtor and who has to pay rupees 1000, and he became insolvent, and we have to close his account. What we have done, we have passed the entry bad debts account. We have treated that particular amount, that is rupees 1000, as a bad debts, and we have removed that debtor from the list of debtors. That's why we have credited him. Since we have closed his account and we have treated that particular amount as a bad debts, as a loss, we have treated that amount as a loss. So we have closed that particular account. If in future, after 2 years or 3 years, if that particular debtor will be in a condition to pay your debt, and he says ki I want to repay your debt, which is rupees 1000, in that case that will be treated as a income. Why it will be treated as an income? Because in the previous year what you have assumed, you have treated this amount as a loss. So since in the previous year you have treated this amount as a loss, if this amount is recovered in the future years, upcoming years, then this amount will be treated in an income, and this will be denoted with the word bad debts recovered. Since it is an income, then the entry would be all incomes, all incomes, all expenses, losses comes under nominal account, and the rule of nominal account says debit all expenses and losses and credit all income and gains. Because of this rule, since bad debts recovered is an income, and incomes you have to credit according to the nominal account rule. So the entry would be cash account debit to bad debts recovered. Since you are getting money, in spite of the fact that these are the bad debts recovered or what, so you are getting money, so entry would be cash account debit to bad debts recovered. Bad debts recovered is our income, and all incomes comes under nominal account. So according to nominal account, you have to credit this bad debts recovered. The next transaction is interest on capital. Capital is brought into the business by whom? By the owner. So he expects some interest on that particular capital. So interest on capital, because in business we have to think about from the point of view of the business, not from the point of view of the owner. So interest on capital is an expense from the point of view of the business. Therefore, interest account should be debited, because according to the nominal account, there are three accounts: real, personal and nominal account. And according to the nominal account rule, because nominal account is applicable here, interest on capital is an expense, and all type of expenses comes under nominal account. And the rule of nominal account says debit all expenses and losses. So what we have to do in this particular case, we have to debit this interest on capital. The entry would be interest on capital account debit to capital account. Why we are crediting capital account? When owner bring capital into the business, what we have done, we have passed the entry cash account debit to capital account. Whenever there is an increase in the liability or there is an increase in the capital, then we have to credit that according to the modern approach. So we are not paying this interest on capital in cash. Since we are not paying this interest on capital, the ultimate result of this interest on capital would be on capital. Means your capital is increasing, owner's capital is increasing. For example, he has invested into the business rupees 50,000, and interest on capital due at the end of the year is rupees 1,000. The total amount a business has to pay to the owner is rupees 51,000. So for that, what we have to do, we have to credit, we have to increase the capital account. Next is interest on drawings. Interest on drawings, if the interest is charged on drawings, then it will be an increase in the income of the business. Interest on drawings, if owner has withdrawn something from the business, if he has withdrawn some cash from the business of, let's take an example, he has withdrawn rupees 10,000 from the business. Obviously in that case he has to pay charge on that, he has to pay some interest on that particular drawings. And interest on drawings, as we are analyzing this transaction from the point of view of the business, not from the point of view of the owner, in that case interest on drawings is an income for the business. If interest on drawings is an income for the business, then it would be credited, because all income, expenses, losses, gains comes under nominal account. And the rule of the nominal account says debit all expenses and losses, credit all income and gains. So this is an income, and according to this rule you have to credit interest on drawings account. What should be debited? And debited would be either you can debit drawings account or you can debit capital account. If you want to reduce the total capital invested by the owner, then in that case you would be debiting capital, or you can add it to the drawings account. So the entry would be drawings account debit oblique capital account debit to interest on drawings account. The next one is purchase and sale of investment. When business has some surplus money, what they do? Either they invest in some securities and at the time of the sale of these investment, the sale price of investment is recorded in the books of accounts. Now what we have to do? If there is a profit on sale of investment, or if there is a loss on sale of investment, the entry would be, if you are purchasing investment, so investment is what? First, what you have to do, you have to recognize, you have to analyze the transaction given to you, and the transaction is that we have purchased investment. Investment is asset, and all type of assets comes under real account. Since we are purchasing investment, so investment is assets, one is asset is coming, and when we are purchasing investment, what we have to give? We have to give cash. So both are asset in this case. So investment is also asset and cash is also asset, and all type of assets comes under real account. And the rule of the real account says debit what comes in, credit what goes out. So what's coming in? investment. So the investment account would be debited, and since we are buying this investment, we have to pay cash, so we have to credit cash account. So entry would be investment account debit to cash account. Next is, if we are selling investment, in that case, when we are selling investment again is an asset, and when we are selling investment, cash is again an asset. When both are asset and all type of assets comes under real account, again rule of the real account is debit what comes in, credit what goes out. We are getting cash. When we are selling investment, we are getting cash. The entry would be cash account debit to investment, debit what comes in, credit what goes out. If there is any profit on the sale of investment, then in that case you have to debit this cash account with the actual amount, selling price. So let's take an example that we have sold this investment for rupees 10,000, but the price of this investment was rupees 8,000. So there is a profit on the sale of investment. So we always debit this cash account with the actual amount you have received. So we have sold this investment for rupees 10,000. So cash would be debited with rupees 10,000. To investment account, in investment we'll show that amount which was representing in our books of account. This investment was of rupees 8,000 in our books of account. So 8,000 would be shown in the investment account, and cash we have received for this sale of investment is rupees 10,000. So there is a profit of rupees 2,000. This profit would be shown as to profit on sale of investment. The entry would be in that case cash account debit to investment account to profit on sale. The next one is income tax paid. Income tax should be debited to capital account or drawings account and credited to cash account in case of sole proprietorship and partnership firms. Income tax is a personal expense, since income tax is paid of a owner. So in this particular case, the entry would be capital account / drawings account to cash. Since we are paying this income tax in cash, so cash is going out, so we have to credit this cash account. The entry would be capital account / drawings account debit to cash account. Next is personal expenses of the owner. If personal expenses of the owner are given in the question, in that case you have to treat all the personal expenses, that is life insurance premium, income tax, personal telephone bills. If these expenses are given, then these expenses are the personal expenses of the owner. In that case, we treat all these expenses as drawings. Whatever the transactions related to owner, we treat either as a capital. If he is investing cash into the business, then we treat it as a capital, or if he is withdrawing something from the business, then in that case we treat it with a name term drawings account. Or if we are paying some personal expenses of the owner, some expenses of the personal expenses of the owner are paid by the business, in that case we treat these expenses as personal expenses, and this will be denoted with the term drawings account. The last one is the events affecting business, but they do not involve any transfer or exchange of money. For the time being, they would not be recorded in the financial books. As we had discussed earlier as well, all those transactions which do not have a financial impact on the business will not be recorded in the accounting. Let's take an example here that we have ordered goods. We just order for goods. We have not paid anything in advance. We have not received any goods. So there is no financial transaction. So this transaction would not be recorded in the books of accounts. Thank you so much, everyone.